Hello and welcome to another episode of the Energy Connects podcast. I'm your host Chiranjib Sengupta, and today we are looking past the current volatility to understand the structural shifts playing out across global energy markets. 2026 has been unprecedented for the energy sector globally. The global economy is navigating the 2-month closure of the Strait of Hormuz, one of the world's most vital energy choke points. At the same time, we are also witnessing a fundamental realignment of traditional alliances, such as the UAE's exit from OPEC. Joining us today to help make sense of these developments is Norbert Rücker, the head of economics and next generation research at Julius Baer. Norbert, it's such a pleasure to have you back with us at the Energy Connects podcast.
Well, thanks for having me.
Thank you. To start off, last week, you characterized the UAE's exit from OPEC as a breakaway during the Queen stage. How do you see that, and how do you see the implications for this for the oil market?
Well, this is obviously a reference to the cycling and them sponsoring one of the most successful teams that you have in cycling and racing currently. Well, to be honest, for us, it was somewhere between surprising and expected, because you could simply see the bigger kind of framework, the bigger picture on the oil market, which I guess is underlying this decision, because there might be some politics aspects to it, but for us, it's mostly an economic decision. And this big picture on the oil market is one where you have ample supplies. Longer term, it's one where the oil market moves into stagnation, if not decline. It's one where you have more competition on the supply side. And I guess with this kind of in mind, the decision to leave OPEC, the decision to be better able to monetize the past year's investments in oil, but also in gas and beyond, and to simply have more flexibility, that I guess seems very rational.
Now, we are 2 months into the conflict, more than 2 months into the Middle East conflict. The Strait of Hormuz remains effectively closed. With that as a context, what's your outlook for the global oil market?
Well, with any crisis, there comes the surprise elements. And I think we've seen some of the surprises. I guess one of the surprises being how this conflict continues to drag on. We expected that it would remain shorter, but there have been also other surprises, namely the one that you haven't seen yet any meaningful damage. I know we're in the ceasefire, but you haven't seen any meaningful damage to the energy infrastructure in the region. Or simply the key surprise, I guess, was how swiftly and to which scale kind of the alternative routes were able to be ramped up. So the exports into the Red Sea, the export directly in the Gulf of Oman being the main ones. So out of that, we're looking at a market, from our perspective, the deficit is less pronounced. The deficit is closer to something like 5% and not the 10% above that you had in initial days, initial weeks of the conflict. Which means you're in an oil market that is now in a different regime. It's an oil market that moved past these uncertainties of the initial shocks into the regime of you have this drawdown of storage globally across the board, some visible, some less visible, and there's breathing room. There's breathing room for this situation to endure past summer, because you have a deficit that is somewhat makes it more manageable. Of course, the big risk, the wild card, the threat out there remains the next regime. If things don't get resolved, if you don't see a slight pickup in trade through Hormuz, then eventually you move in the next regime where you only can maintain stable supplies by even harsher prices, and basically meaning much more demand destruction.
Right. Now, assuming, let's say, we see the sort of normalization and some sort of resumption, and the geopolitical turmoil subsides sometime soon. Now, how quickly do you expect the market to go back to the fundamental values, and where do you see that as the anchor? Like, for example, earlier you had mentioned about high 60s for Brent as a kind of a fundamental value.
Yeah, there's actually really two things for that. The first is kind of the pattern that we're in, the geopolitical pattern. And second, it's really moving back to this old and somewhat new oil market. And there, for us, the prices, the anchor for oil prices, so to speak, if nothing else happens, is somewhere really in the low 60s. And why is that? It's basically the shale production, the prices they need to have a decent return on the investments. So more or less, the elements that you saw really emerge in the oil market late last year, 2025, and especially late last year and towards the end of 2025. So return to this kind of anchor, this kind of market setting. If you look at the geopolitics component, it's not the first time we have some sort of these conflicts. So we still believe that this pattern of a kind of a swift shock in kind of commodity terms, a shock that builds up for maybe some weeks, a few months, topping out and then return to a normal state, that this pattern should still apply. We can draw some reference like the Gulf War in the 1990s. And even there, and the difference was to today, we had serious energy infrastructure damage. Even back then, the normalization happened comparably swift. So talking really about a few months, 2 months, 3 months, something like that. Looking at the situation today, so far with little damage, so far with ships fully loaded, stuck in the Gulf, but ready to basically move to the global market, and with such a strong bullish positioning in the market, we would say that a normalization, a sense of what oil prices do, could happen quite fast.
So Norbert, going back to your earlier point about the historic drawdown that you mentioned, that's while obviously that has helped sort of buffer supplies for at least the immediate term, that also means that countries will increasingly focus on energy security and replenishing those stocks. And do you see then the narrative of energy additions or dominating the headlines in the coming weeks and months?
Mm-hmm. Well, if you look at the shock today, what really makes it kind of comfortable and provides this breathing room is exactly what you said, this strategic storage that you have, the releases now, especially with the speed that we have, but also simply the fact that you moved into this conflict really with well-filled, very well-filled commercial storage. If you do kind of best guesses, so far we've basically run through the commercial storage, and there's still a lot of government storage to be run through in this conflict if things don't change. Does this conflict really lead to energy addition beyond that? Does this conflict really lead to kind of an investment boom on the oil side, like a new investment cycle? We don't think so. We see little chance of that. First, we possibly could see a reaction in the shale business to it, but even that is yet still out. But really because it would not fit with the big picture that we're in. We would not fit with what everyone else sees, that you had ample supplies before, what everyone saw, that you have structural growth coming out of South America, for example, a strong oil boom there, or the spare capacities, as we discussed before, by the Emirates, which will then come to the market. So out of that, we see it as unlikely that the current conflict really initiates and nourishes a new capex cycle or investment cycle in the oil business.
And going back to your comment about the big picture, now if we talk about the resilience of Europe, now while the headlines have focused on the price shock aspect, how significant do you think is the impact of the energy transition in dampening that supply chain shock? And how do you expect Europe to move forward from here?
That's a very important point, because usually every crisis kind of accelerates existing structural change. This is very likely also happening this time. If you look at Europe specifically, we're talking about an oil shock predominantly. So you need to look at the energy transition there, which is basically electric mobility. So far, there's some evidence, or more anecdotal side, that this helped buffer the shock. But at the same time, if you look at the price shock in Europe, it's non-regulated markets, basically. So the price at the pump of gasoline, diesel is really set by the market. You had an initial very sharp reaction, which created a bit of a political backlash. But to be honest, if you looked at the price levels, they remained largely below the peaks that we just saw recently, basically 2022. So it's not an economic pain threshold that prices reached. At the same time, very few actually talked about that in the meantime, you're spending less at the pump because your cars got more fuel efficient, or you're spending nothing at the pump because you're having an EV. And these penetration rates still are low, somewhere between 5%, but nevertheless, they give you some bit of a relief, but a marginal one. I would say the bigger transition impact you actually saw on the gas market. Because there, and especially what has been kind of the ghost haunting still, the memories back of 2022, when really you had this shock in the gas market and then moving into the power market and really having quite devastating short-term economic consequence for Europe. You don't see anything of that currently. Basically, for two reasons. The gas price itself behaves quite well because you're just in this kind of demand flexible kind of period, because now it's dominated by power plants, and power plants, they have the flexibility to shift fuels. So this really contains the gas price so far. But what also happened in Europe, and that's really exactly what you mentioned before, the energy transition. Thanks to the increases in renewables capacities, solar, wind, and thanks to the abundance of this kind of generation over the past weeks and past month, you actually don't see any reaction in the power price so far in Europe, and which means the transition really completely quenched and offset what could have come from the events in the Middle East, translated from the gas market into the power market. So yes, this narrative or this view that the energy transition provides energy security is really proven these days.
That's an excellent point, Norbert. Thank you so much for your excellent insights, and it's been such a pleasure speaking to you. Thanks for joining us for the Energy Connects podcast.
Likewise. Thanks for having me.
Thank you very much. That was Norbert Rücker from Julius Baer. Thanks for joining us for this episode of the Energy Connects podcast. I hope you really enjoyed this episode. Don't forget to follow us on social media and subscribe to our newsletter for regular updates. You can also go to energyconnects.com for comprehensive coverage of the energy industry and more podcast episodes like this. A big thank you to our amazing production team working behind the scenes to bring these episodes to life. Thank you, and I'll see you soon on the next episode of the Energy Connects podcast.